What we do notice is that when these measures reach extremes, I compare them to an elastic band. The further you stretch them, the more likely they are to snap back.
Welcome to another Breakout with Breaking Views, brought to you by PGIM. My guest today, as ever, is Edward Chancellor. This week, you have a slightly doomsday prediction, which is that the U.S. stock market is headed for a fall, that you called it, this time isn't different, but scarier. Explain why it's scarier.
I'll first of all explain why it isn't different, because every time we reach a valuation peak in the market, some guy on Wall Street or wherever comes out and says, "Don't worry about the valuations being high. The valuation clocks no longer work." We've seen that. I mean, if you remember, 20 odd years ago, at the end of the dot-com bubble, people were saying that. In the 1920s, people were saying that, and they're saying it again today. And what's interesting is that the measures that historically have been reliable valuation tools are now indicating the most expensive markets, more expensive than 1929 and close to the high levels of 2000.
Why don't you tick through some of those measures that you cite in your column?
Well, the most famous valuation tool is developed by the Nobel laureate Robert Shiller of Yale, and it's called Shiller's cyclically adjusted price earnings ratio. And why Shiller takes the cyclically adjusted earnings is he takes the 10-year trailing earnings to smooth out for fluctuations in the business cycle. And that in fact, actually earlier was developed by Benjamin Graham, the father of security analysis in the 1930s. And that's been a fairly reliable tool. Now, if you remember, that ticked out the 2000 bubble. Its average level is 90 earnings multiple, and currently is at 37. So in order to go back to its mean average, it would have to fall by nearly 50%. Now, there's another measure. The Shiller PE looks at earnings. There's another measure that looks at the asset values of companies called the Tobin's Q, developed by my old friend Andrew Smithers. Well, actually first developed by Shiller's colleague at Yale, another Nobel laureate, James Tobin, but taken forward by Andrew Smithers in London. And the Tobin's Q is telling almost exactly the same story as the Shiller PE. In other words, to get back to fair value, the market would have to fall by 50%. Now, my former colleagues at the Boston investment firm GMO have another measure, which is based on the mean reversion of the current price earnings ratio and the mean reversion of profitability. And GMO's forecast, given that the price earnings ratio at the moment is 3 times the historic average, is that stocks would have to fall by nearly 8% a year for 7 years in a row, which I think is a collective decline of around 55% before reaching fair value.
So these 3 measures that you cite, and there are of course others that will tell us that US stocks are overvalued, but timing is everything, right? So, I mean, these things don't actually tell you that now is the time to get out of stocks or to short them or whatever it is, right? I mean, we could be in this overvalued construct for quite some time.
Possibly, but I think not in this case. Smithers points out that Tobin's Q only reaches cyclical peaks once every 20 years. So a bit like the bond market, which has 40-year cycles, long cycles. Shiller famously made a presentation to the Federal Reserve in 1996 saying that stocks were overvalued. And Alan Greenspan, if you remember, talked about the irrational exuberance of the market. And after that Greenspan warning, the S&P doubled over the following 4 years. So yes, that wasn't very good timing. What we do notice is that when these measures reach extremes, I compare them to an elastic band. The further you stretch them, the more likely they are to snap back. So when you get to the elevated levels we are at this very moment, then they actually, strangely enough, provide quite good near-term forecasts. So whereas normally I would say, an elevated Shiller PE, so 1 standard deviation high is telling you nothing. Once you're 2 standard deviations high, then the snapback is on the cards.
Of course, there's an argument that some people would make that, well, in an era of low to negative interest rates, negative in parts of Europe, super low even in growing America, then what does it matter? And even Schiller, I think, as you point out in the piece, has kind of given up a little bit of his argument as a result of the interest rate environment. What's your retort to that?
Well, I mean, Rob, as you know, the last phase of a bull market is when the bears capitulate. And last year, Schiller capitulated, and he started comparing his cyclically, the earnings yield, the inverse PE, the cyclically adjusted earnings yield, to the current level of real interest rates, and said, well, actually, the earnings yield is not too bad. It's currently, Schiller's sort of excess earnings yield is now standing at 2.7% above 10-year treasuries, real yield above treasuries. So that sounds like an equity risk premium, and you're going to get more from equities than bonds, so why not buy them? And I think there are a couple of good reasons for that. One is that you shouldn't really compare equities, so the yields in equities, which are real assets, with bonds that are nominal assets. Sometimes they move together, other times they move in the wrong direction. But more importantly, I think, is that when inflation comes along, this model completely breaks down. I looked at Schiller's data from the early 1970s, and lo and behold, you had the same excess earnings yield in the market in 1970. And what did you get? You got 10 years of negative returns. Now, bear in mind that the market in 1970 was not as overvalued as it is today. So if inflation comes back into the system, you can imagine, then actually the excess earning yield mean nothing, because bond yields will rise, and so that current rather 10 years prop to the market will fall away.
So given this backdrop, sort of break it down. What do you do as an investor? Do you get out of indexed funds and algorithmic trading? Do you get out of stocks? Do you diversify away from the US? What do you do?
Well, I think first of all, you should brace yourself for low returns from US stocks. So you might adjust your spending and your retirement plans. But more practically, I think the key point is that the US market is the most overvalued. It currently stands at 65% of the MSCI World Index. That's the highest ever level. So, I mean, I don't even remember in the late 1980s, the Japan market was more than 50% of the MSCI World. So when whichever country is the leading, it gets to more than 50%. That flashes a warning sign. I think so. Get out of the US equities, and I think perhaps more importantly, the era of indexation, of just passive investment, is coming to an end, and you need skilled active managers, skilled stock pickers to succeed in what's going to be a very tricky battle for investment survival.
All right, well, thanks. On that cheery note, Eddie, appreciate it as ever, and we'll be back with another breakout from Breaking Views soon.
Thanks.